Good morning and a very warm welcome to the seventh episode of HSBC and CRISIL's SME Knowledge Series. Today's session is about the Indian steel industry and we call it the flux in steel. Thank you everyone for joining. Before I introduce my first speaker, there are just a few housekeeping rules that I'd like to introduce to you. All attendee lines will be muted and video will be disabled during the session. The Q&A option at the bottom of the menu bars, whether you are on your phones or your PCs, will be on throughout the session. Please feel free to use the Q&A bar and ask us as many questions as possible. We will try to take them at the end. Should we not be able to take your question in the end, we will definitely reach out to you post the session and answer your questions. Please also note that this session is being recorded externally. Also, post the session, we will be sharing the entire session presentation, a short 6-minute podcast which encapsulates the whole essence of the presentation, as well as the entire replay of the hour. All of these will be shared with all registered attendees. Thank you. With that, I'd like to introduce my first speaker for today, Dilip Gopinathan, who is Senior Vice President and City Head for Business Banking, HSBC India. Over to you, Dilip.
Hey, thanks, Subhash. Hope I'm audible now.
Yes, you are.
Oh, thanks. So very good morning to all of you and many thanks for joining the 7th season of the CRISIL HSBC Knowledge Series. Over the last 6 seasons, we've covered a wide range of sectors. And today we'll be looking at a core and possibly one of the most critical sectors, one which provides a clear indication of how the economy is moving, the steel sector. Now, as many of you would be aware, India was the world's second largest steel producer last year, and it became a net steel exporter in FY20. Surprisingly, China is now the largest importer of Indian steel. The growth in the sector has been primarily driven by domestic availability of raw materials such as iron ore and obviously cost-effective labor. The steel sector has been a major contributor to India's manufacturing output. In fact, in the recent IIP index released, steel has registered a positive growth along with 2 other core sectors. If I just can get into some more details, the self-reliant initiative has caused the Indian steel companies to actually boost their steel production capacity. For example, we have SAIL, which has announced doubling of its capacity at 5 of its steel plants. And Tata Steel has decided to increase capacity at its Kalinganagar steel plant, and JSW has spent a little over $4 billion capital expenditure program. At the same time, there are a host of government initiatives in the sector helping drive the sentiment. For example, the government has introduced a steel scrap recycling policy to reduce import. They've also levied export duty of 30% on iron ore to ensure supply of domestic steel industry. And obviously, the government's focus on infrastructure and restarting road projects is aiding the demand for steel. And if you're aware that the rural economy pickup, the likely acceleration in rural economy and infrastructure is expected to lead to growth in demand for steel. While there are many positives to look forward, there are challenges before the Indian steel industry. For starters, the Indian steel industry is often regarded as uncompetitive globally from a perspective of conversion cost from iron ore to steel. A recent Niti Aayog report explains that there's an $80 to $100 difference in cost, which is primarily led by logistics, finance, power, import duty, the clean energy cess, and taxes and duties on iron ore, etc. I came across an interesting study on digital disruption and application of emerging technologies in steel. This is interesting because when we think of steel, we usually don't consider the impact of digital disruptions on such organizations, and usually steel companies tend to be overlooked. Because when we think of digital, we always think about e-commerce and new age. But with faster adoption of Industry 4.0, there are quite a few challenges faced by steel companies which can be solved by emerging digital technologies. First, the complex value chains that pose a serious challenge to the metal and steel industries. Digital can actually help organizations take steps to deal with the vast amount of interconnected assets, the varied client base, a large number of items with changing quality requirements, and complicated distribution channels with various margins. Secondly, the variability across the steel industry, primarily in processes, production, supply chains, and labor cost, decreases as digital connectivity is embedded vertically and horizontally. At HSBC Business Banking, we engage with a lot of SME companies in this sector, and the SMEs in India play a vital role in this segment. For one, the SME traders preserve an uninterrupted float of metal within the domestic marketplace. They actually form the backbone of the supply chain across sectors like auto engineering, consumer durables, etc. Secondly, in long products, SME manufacturers, though they don't have a scale, but are well distributed across the country and provide timely supply to various rural as well as urban infrastructure projects. I think I've spoken too much on economics, but we do have an expert with us today. Let me introduce to you our first speaker, Mr. Adish Verma, Senior Economist at CRISIL. Adish has more than a decade of experience in economics research. He's currently Associate Director and Senior Economist at CRISIL's Corporate Economics Cell, where his focus areas have been monetary policy and public finance. Apart from publishing research reports on various economics and policy issues from time to time, he has written a number of op-ed articles for leading national dailies. Prior to CRISIL, he's worked with Tata Group's economics department. And apart from working in areas of macroeconomics, he was also involved in doing sectoral studies in group's interest and the country risk analysis. Over to you, Adish.
Thank you so much, Dilip, and delighted to be a part of this session. In my talk today, I'll be largely focusing on growth issues. What are the positives? What are the negatives for this year, as well as in the near future? Now, since these are festival times, let me begin with the positive news first. So with regards to the COVID situation in the economy, there are two positive developments that we are seeing. One is that at the national level, the COVID curve has started declining somewhere from mid of September. Another is that the recovery rates have been gradually moving up. Another positive development is that the spread of COVID in the rural area has slowed down. Something from 20% penetration in rural district as of June. This rate moved up very fast as of August to as high as 50%. But from there on, in the next 2 months, that is still October, we saw this number going up only very marginally. This is a good thing because rural demand this year is very critical for the Indian economy. But still, there are a few monitorables, and I must say these are worth keeping in mind. One is that the caseload is still concentrated on states which are having large share in India's GDP. These states are Maharashtra, Tamil Nadu, Karnataka, and Andhra Pradesh, which together account for about 36% of India's GDP. Second is that even though at the national level, the COVID cases have been coming down, there are still states such as West Bengal, Kerala, Odisha, and Delhi, where we are still seeing the number of cases rising. So these could possibly become hotspot and may lead to a second wave. So one must watch out for these danger signs. And that could sort of lead to if that sort of leads to a lockdown again in those areas, the economic activity can again go for a toss. Now, another positive development, which brings me to my next slide, is the improvement in the high frequency indicators that we have now witnessed for the second consecutive month. Most of these indicators have improved in both September and October. In fact, some of them, such as the GST collections or PMI index, or in fact, vehicle registration, are not only above their pre-COVID levels, but have also, crossed the levels where they were a year back. If we move to the next slide, where we try to show the movement of these high-frequency indicators in the form of a heat map, we can see that, after Q1, where everything was in red because we were completely shut, September has started seeing some greens, and as I showed in the previous slide, October also, maintained the same territory. But having said that, I must emphasize that we still need to exercise caution with regards to these development. One, because we still need to rule out whether this improvement is on account of the pent-up and festive demand. And for that, we need to still wait for a few more incoming monthly data points so as to see whether this economic recovery sustains. And as I mentioned, there is also a possible risk of a second wave, which could also jeopardize this kind of a recovery. Now, moving to the next slide, I think I want to highlight the amount of economic loss that we are looking at on account of this pandemic shock, and this is very critical. And to do that, I would like to draw parallels from the last shock that the Indian economy faced, which was in 2008-9, and that was a global financial crisis. So if we look at the left-hand side chart, we were hit by the global financial crisis. The growth slowed down, but we were still able to grow at a positive 3% rate. And the government was also proactive. We saw a lot of active fiscal and monetary stimulus coming in. The global growth was also supportive after the crisis. And as a result, we were able to move back to the trend level of growth very fast. Within 2 years, we were able to catch up to the pre-crisis growth levels. And we grew at about 8.2% in the next 2 years after the global financial crisis. Now, what is happening this year? If we look at the middle portion, we have been hit by COVID crisis, which means we are looking at a -9%, growth this fiscal, and next fiscal's forecast we have put at 10% real GDP growth. Now, even with that, we will be barely able to catch up with the growth, the GDP levels of FY20. And even if we manage to grow by 7.4%, which still looks like an optimistic scenario in the next 2 years, we will still be looking at a permanent loss of about 13% of real GDP, which in nominal terms amount to rupees 30 lakh crores. And even after growing at that level, we will still not be able to catch up with the trend growth which was seen before the crisis. Now, to be able to catch up with the trend, we'll have to grow by 13% over the next 3 fiscals, which is something which we have never witnessed in the Indian economy. So all in all, what this means is that not only we are looking at a large amount of permanent loss of economic output, the Indian economy may also have to wait for many more years before it can, catch up with the pre-COVID trend level. And then there are challenges on the way, which brings me to my next slide. The loss in consumption, that we are witnessing, or the recovery in consumption may be very slow to revive. So one is that there is a large-scale income loss that we are witnessing, which itself is negative for consumption. But even when people who are employed and witnessing slower income growth, for them propensity to save has gone up. And we saw that how, despite lowering of deposit rates, the deposit growth has continued to rise. So this means that even if the government were to give fiscal stimulus and try to revive consumption demand, the multiplier effect of that will be lower than what it would be otherwise, because there will be increased propensity to save rather than consume. Consumption, by the way, is the biggest driver, and therefore it's critical that it revives fast. The next important driver for Indian economy is the investment cycle, which has already been on a downtrend over the last decade, from about 33% of GDP in FY12. The investment rate in the economy is down to about 28% now. In the kind of uncertain demand environment and an environment where capacity utilization levels are already low, it is highly unlikely that the private sector will be wary of, will be looking to invest. So in those instances, the government can step in, but given their fiscal stretch, I think even government is not, capable to put in capex this fiscal. We have seen, both center and the state governments have cut down their capital expenditures in the first half of this fiscal, even as they have, maintained their revenue expenditure parts. Direct support by fiscal support of the government in India has been inadequate. It is roughly at about 1.8% of GDP, which is much lower when compared to, not only the advanced economies, but even for emerging economies, for which the average direct support comes to about 3% of GDP. Now, with the improvement in GST collections and if this economic recovery were to sustain and the government does decide to come with the next round of fiscal stimulus, which they are hinting at, we can see some upside to our -9% growth forecast. And plus, there's also additional good news in terms of the agriculture front, because the monsoons have been favorable this year as well, and which has led to increased sowing this fiscal. So these two, positive developments can provide some upside to our -9% growth forecast next fiscal. Now, coming back in terms of challenges, we are also witnessing high inflation, which is something of a policy conundrum, for the government. In fact, I must say that India is possibly the only inflation targeting country at the moment which is witnessing high inflation, and which has certainly complicated, the monetary policy action in the country. We have seen that how, in the absence of fiscal policy support, monetary policy has been doing the heavy lifting in the economy. But because of its inflation targeting mandate, the high inflation has forced the RBI to stop its interest rate cycle. Now, having said that, the central bank has certainly used the other policy tools to support the liquidity and financial conditions in the economy. Last but not the least, the global support may be weak. We are seeing that how in certain parts of the world, the COVID is again rearing its head. In Europe, some countries have already gone into lockdown. In US, cases are rising, so which means that the current global growth forecast of IMF, which is at -4%, could be possibly cut down, and which means exports from India may continue to remain weak, going ahead. So I think let me stop there and hand it over to Kostav, who is our steel sector expert at CRISIL, who will take you through the next set of slides. Over to you, Kostav.
Thank you, Adish, for an insightful presentation. Let us now start with the steel segment, where we begin with the global steel dynamics. Here, in this chart, we have plotted the regional demand growth trend for key geographies. It is quite evident that past growth was largely led by China, which constitutes over 50% of the world's steel production as well as consumption. China was the first to be hit by COVID and saw its manufacturing PMI fall to lowest levels in Feb. But once the lockdown was lifted in March, China's PMI shot to 52. Consumption as well as production has only picked up since then, on the back of government-led infra boost, especially in railways and port segment, which will lead to a 5 to 7% demand growth in the current year. On the other hand, the rest of the world continues to battle slowdown, even into the third quarter, mirrored in the steel production numbers, which has fallen by 13% in the first 3 quarters of 2020. Major economies like EU have seen the sharpest decline, and new lockdowns is expected to further delay recovery in these regions. However, low base and initiatives by the government across the globe in order to streamline their economy will aid recovery in the next year, where China shall witness a growth of 5 to 7%, while the rest of the world is expected to register a growth of 7 to 10% on a low base. Weak demand scenario will drive operating rates lower, which brings us to our next slide. On the left-hand chart, we have plotted global capacity along with utilization rates. One can clearly see that the global utilization rates have risen over the past few years, led by rise in demand along with culling of old inefficient capacities. In fact, while the production has grown at a CAGR of 2 to 3% over the last 5 years, net capacity addition has been negative, which has resulted in utilization levels climbing to 79% in 2019. However, weak demand scenario in the current year will push back utilization levels lower to around 73 to 74%, only to recover in the longer run. Now, if you see on the right, we have plotted the utilization levels of key regions. The rise in global utilization levels can be largely attributed to China and EU, where capacity curtailment has led to a rise in utilization levels over the past few years. In fact, China's operating rates reached a 10-year high of 82% last year and is expected to rise further in 2020. USA, on the other hand, has seen some improvement in production levels in recent years with the imposition of trade barriers and quota tariffs. Now that we have seen the global demand supply dynamics, let us see how the domestic steel industry has performed in these difficult times. Steel demand growth was already struggling in fiscal 20, led by consumption and construction slowdown, resulting in industry clocking only 1% growth. On that came COVID, which drove domestic demand lower by 55% in the first quarter, given nationwide freeze. Demand witnessed a modest recovery in the second quarter, limiting demand decline in the first half to 30%. Despite the sequential recovery, demand remains in the negative territory on a year-on-year basis, even in the second quarter. We expect recovery from the third quarter of the fiscal, led by pent-up demand release from manufacturing sector, coupled with pickup in construction activity. Fourth quarter will mark full-fledged recovery, which we believe shall continue through fiscal 22. Now let us compare the current slowdown to previous down cycles. In order to bring out the story of demand recovery, we have plotted steel demand volumes, which is the bar, and annual steel demand growth, which is the line chart. If we look at previous two down cycles, as highlighted in the red section, two facts come out. demand has never compressed and recovery has been above the average growth rate. This time around, we expect a 10 to 15% recovery in the next fiscal, which should be above the trend line of the last 5-7 years. However, any major upside to that will be limited by three factors. First, high central fiscal deficit will be observed in fiscal 21, which will be even higher than the 6% that was witnessed during the global financial crisis. Also, last time around, the recovery was on a low base, with the steel demand volumes being half of the current volumes. Loss of income impact on consumption-linked sectors, especially discretionary, will weigh on steel demand. And thirdly, weak private investment spending will add to the woes. Now let us see how it will translate to demand from each end-use sectors. On the left-hand side, the chart, we have plotted the end-use sector as well as the demand growth. The bubbles here are domestic steel demand growth along with end-use build-up as depicted in the bottom. Pent-up demand release from ongoing projects, both in real estate as well as affordable housing side, will help building and construction in fiscal 21, which is 35 to 40% of the domestic demand. Infra segment, which is another 25 to 30%, will see government push to steer economy back, hence seeing 12 to 14% growth next year. But a large part of this would be ongoing projects, as new awarding remains on weak footing. Auto production, which shall also contract by over 15% in the current year, will also see revival in the next year and witness a double-digit growth. This shall enable around 13% growth in fiscal 22. However, volumes would still be lower than fiscal 19 levels, thus weighing on a 5-year CAGR. In terms of segments, we have plotted flat and long steel demand growth on the right. Fiscal 21 will see deeper impact on flat steel, as nearly half of it is linked to consumption and industrial capex. Long steel will see lower cut as rural housing and key infra projects come to the rescue. With MSMEs having a larger presence in the long steel segment, sharper recovery in demand will limit volume impact for these players. Even for medium term, income recovery and private capex will take time to streamline, while key government initiatives on housing and infra front will lead healthy recovery, hence reflective in long and flat steel sales. Now let us dive into the flat steel value chain and see which of these segments are expected to be most impacted in the current down cycle. Flat steel can be broadly classified into 4 segments. The first segment consists of hot rolled and cold rolled coils. HR and CR coils are the primary flat products that are manufactured and are extensively used in automotive and white goods industry. The second segment is galvanized steel, which dominates the building and construction segment. The other 2 segments are plates as well as value-added steel and are used in various downstream industries. Flat steel space in India is largely dominated by large indicated players, and thus most of the manufacturing is done through BF-BOF route, which accounts for over 90% of the domestic flat steel production. Now let us understand the flat steel industry from the end-use perspective. Building and construction, which includes housing, infra, as well as industrial construction, accounts for almost half of flat steel demand. It is closely followed by engineering, packaging, and consumer goods segment, accounting for another 2/5 of the flat steel demand. Automotive accounts for the rest. Flat steel is manufactured either in the form of coils or plates. HR coil at a gross level accounts for over 90% of the domestic flat steel market. While 60% of HRC is sold in open market, the remaining 40% is used to produce cold rolled coils, which is further processed to manufacture galvanized sheets and color coated products. Now let us see how each of these segments will perform in the current year and next year, which brings us to our next slide. Here we have plotted each of the flat steel product at a gross level, with the size of the bubble being demand numbers from the product, which has been mapped against its growth across the years. Weak demand from auto segment drove demand for HR as well as CR coil lower in fiscal 20 and is expected to drive demand lower in the current year as well. Smaller segments like GPGC as well as color coated products have outperformed in the recent past and will continue to do the same. Rising usage of steel sheets for roofing in rural belts as well as modernization and erection of railway platforms is expected to drive steep demand from the segment. Now let us see how the other half of the industry is expected to perform. Long steel can be broadly classified into three major segments: bars and rod, structural, and railway products. Non-alloy bars and rods is a key component used for construction. On the other hand, alloy bars and rods are widely used in automotive industry. Structurals are used for industrial construction as well as for power transmission and telecom towers. The third segment is railway products with rail lines as the key product. Unlike flat steel, long steel is manufactured through all three routes: induction furnace, electric arc furnace, as well as the blast furnace route. IF and EF route accounts for around 60% share in their production, while the blast furnace route is being dominated by the few large players. When it comes to the key downstream segments, construction segment comprising of housing, infra, as well as industrial construction account for over 75% of the total long steel demand in the country, with the remaining demand arising from automotive and capital goods. Unlike flat steel, MSME players in the industry are present across the value chain and accounts for over 65% of the long steel production, with even higher share in the downstream rerolling in the traders segment. Now that we have covered domestic demand, let us see how exports have panned out and how critical is the segment for the domestic manufacturers. Export story for India is largely opportunistic in nature and as reflected in the chart on the left, where exports pick up only to fill lacuna of domestic demand, as seen over FY15 and FY17. In current fiscal, we expect large players to export 30% higher than last year to around 10 to 12 million tons. In fact, in the first half itself, we have exported over 6.5 million tons of finished steel. This is over and above the semi-finished steel, which shall also double in the current year to 5 to 6 million tons from 2.8 million tons last year. Imports, on the other hand, have fallen since the imposition of anti-dumping duty in 2016 and will continue to slide in the current year as well on the back of weak demand scenario. So now let us look at what we export and where we export. That brings us to our next slide. As you can see in the top left chart, flat steel dominates the export landscape for domestic steel makers. In fact, flat steel accounted for 89% of the finished steel exports basket. Within flat steel, HR and CR accounts for almost 3/4 of the total flat steel exports, as highlighted in the chart on the bottom left. In the right-hand side, we have plotted the key geographies to where we export. As one can clearly see that Asia, Middle East, and other smaller economies are key exports markets for India, after US and EU both impose trade barriers as well as quota tariffs on us. Along with these economies, China has become a lucrative destination for exports in the current year, with exports of both finished as well as semi-finished steel to China growing leaps and bounds in the first half of the current fiscal. Better exports will limit utilization fall to a certain extent, as can be seen on our next slide. So while domestic demand is expected to fall by 12 to 13 million tons, some damage control will be done in the form of incremental 3 million ton exports of finished steel and 3 million ton of semi-finished steel exports. Further, 1 to 2 million ton of import substitution will be limiting crude steel production fall to just 4 to 5% in the current year, thereby limiting utilization fall to 74% in the current fiscal. Also, the 7 million ton of capacities will be added during the fag end of the current fiscal, but effectively will start production from next year, which will lead to utilization levels staying range bound in fiscal 22 as well. What is more notable, however, is that we'll add 21 million tons of capacities over the next 5 years, which itself has various stories to it. All additions will be housed by large players, resulting in their share of capacity rising to 65%. Almost 18% of this 21 million ton capacity is on the flat steel side. And with flat steel taking more time to recover, it shall weigh on their utilization levels or drive more flat steel exports. On the other hand, long steel will see better utilization levels due to limited addition in a modest demand growth scenario. This more so comes at a time when industry profitability saw a sharp downturn in last fiscal, which brings us to our next segment on price and profitability. Steel prices are determined by global demand supply dynamics. So before we move to domestic price and profitability segment, let us see how the global prices have panned out. As you can see on the chart on the left, global prices have been on an upswing after falling below $400 mark in the months of April and May in the current year. In fact, prices have risen sharply since and is currently hovering above the $500 mark. In the same time, coking coal prices have marked a steep fall, while iron ore prices have remained resilient due to supply disruptions. With slower rebound in raw material prices, gross spreads are expected to move higher, which is highlighted on the chart on the right. Going forward into 2021, steel prices are expected to trade higher at around $500 to $520 per ton. While coking coal prices are expected to rise with increase in demand, iron ore prices are likely to moderate with supply normalization. This will likely to lead to marginal uptick in gross spreads in 2021. Now let us see how this will translate into domestic prices. As one can clearly mark from the chart on the top left, domestic prices fell sharply by 16% following global cues back in 2015-16, which led to the imposition of anti-dumping duty. Healthy domestic demand aided better pricing scenario for the industry, peaking until fiscal 19. However, as global and domestic markets came under relative pressure last year, we saw domestic prices fall sharply by 12% in fiscal 20. Long steel prices are relatively much more resilient and protected their turf. In the current fiscal, we expect domestic prices to rise despite weak demand on the back of rising raw material costs for non-integrated players, along with high landed cost of imported metal. While flat steel is expected to see an increase of 4 to 5%, long steel is expected to see a sharper growth of 5 to 7% to reach Rs 43,000 per ton for the first time. Now let us deep dive into how this has panned out over the last few months. While the sudden surge in domestic prices have surprised many, one should note that domestic HR prices are still at a discount to a landed cost of international steel, as shown in the chart on the left. One can clearly see that the domestic flat steel prices, highlighted in blue, continue to trail international landed steel prices, highlighted in gray. Converting these prices to profitability, let us look at the gross spreads per ton, which slid sharply in fiscal 16. Peak realization aided the spreads for the larger players in FY 18 and 19, which also reflected in a healthy margin profile. Major correction in gross spreads occurred in fiscal 20 as domestic prices slid by 12%. On fiscal 20 spreads, we further expect a 3 to 5% fall, which if you compare to the previous down cycles, will be way smaller, hence limiting margin fall to only 50 bips for the larger players, which is likely to be regained in fiscal 22 with pickup in prices. While large players continue to enjoy healthy margins despite the slowdown, most MSME players are staring at losses in the current year, which brings us to our next slide. In the left-hand table, we have plotted the financial profile of over 250 MSME players. One can clearly note that the smaller players industry survive on thin margins, which are already under severe stress. Further, sharp volume decline in the current year is expected to weigh further on the revenues and margin for these players. The players have benefited to a certain extent with moratorium extension and working capital loans in the form of emergency credit line guarantee extended to them. Further, larger players in this segment dealing with integrated players have also benefited from extended credit period, while smaller players in the segment saw greater struggle with a rise in cash and carry deals. However, low gearing and shorter cash conversion cycle with the revival of demand in the next year is expected to limit the stress on these players. Players must now look at new opportunities to get out of this current slump. National infra pipeline will drive demand for flat steel, which will provide a much needed impetus to the ailing traders in the segment. Over 100 lakh crores is expected to be invested with power and water supply segment as well as sanitation driving demand. With share of trade sale in the flat steel being higher in the infra segment, traders will see a sharp volume rise. High-grade steel. High-grade steel like electrical steel and galvalume are increasingly finding its application in the domestic market, with India Largely being import reliant for the segment, it provides immense potential for the traders. Increasing renewable capacities, especially in the solar space, is also expected to drive demand for special steel like galvalume. Exports market is currently catered to by the large integrated players. With China losing some competitive edge over the years, it provides domestic steel players a scope to look at new geographies, especially in Africa and South America, outside of India's traditional exports market. While industry also faces some challenges, near-term opportunities outweigh the challenges. And preparing themselves for the several opportunities will help the players in the current path to recovery from the mayhem caused by the pandemic. Now I would like to hand over the presentation to Subhash for the Q&A session.
Thank you, Costa. Thank you. Thank you, Adish. Thank you, Dilip, for that amazing session. Ladies and gentlemen, now you can ask questions using the Q&A bar at the bottom of your screens. You have the entire CRISIL analyst team here waiting to answer all your questions. Please feel free to ask as many questions as you'd like. We'll just give it a minute to our guests to type their answers in. Ladies and gentlemen, you will see a Q&A section at the bottom of your screens that can be used to ask questions. We have our first question today. What do you think is the total market size for steel in terms of INR?
The total steel industry is around 5,000 billion rupees currently as of FY20. That will include from the overall manufacturing segment. We are not double counting the traders in the segment. In terms of the players that the revenue that the players generate, the manufacturers, it is close to 5,000 billion rupees.
Thanks, Costa. We'll give it a few more minutes to ask any more questions if anybody has. So I've got my next question here, which says the current prices of HR are on the rise. What is your outlook from Jan to March 2021 in terms of how HR is going to perform?
So as you have seen that the prices have risen over the last few months, and it has almost peaked at around 40 to 43,000 rupees per ton currently. We expect some moderation going forward, despite picking off demand, as we expect global prices to moderate as well. Further, the players have already signed contracts with the downstream manufacturers like auto and consumer durables at similar price levels only. So any major uptick from current prices will be difficult. And we expect some moderation going forward.
Okay, thanks. I've got our now there's a flurry of questions coming, Costa. So we'll move on to the next one immediately. The prices of flat steel products have constantly been rising since August, September. Even now in November, there is an increase. At the same time, there's an acute shortage of steel in the market. How would this trend continue, and why is this phenomenon so?
The sudden rise has been largely because of the fact that there's been a pickup in domestic demand. As you know that auto numbers have been really good in the last quarter. Most of the large players, they have reported healthy double-digit growth. Because of the surge in demand, you have seen a surge in prices as well. However, the players, they have been ramping up capacities, ramping up production. They have seen some issues in the form of supply of iron ore and deficit of oxygen as well, which had impacted their production. But the production is only expected to rise going forward, which will lead to lower deficit going ahead. And as I mentioned in the previous Q&A, the prices are expected to moderate going forward.
Okay. Kaustav, do you think the current border issues with China have impacted the demand in some way?
So there has been no material impact on the domestic industry because of that. And despite the tensions with China, China remains one of the key export destinations for India in the current year. If you see, semi-finished steel has actually doubled in the current year exports, and it is largely because of the fact that we are exporting it to China. In terms of domestic demand, there has been no major implications of the same.
Okay, great. Now, what are the kind of margins at EBITDA and PBT level that we can foresee for steel traders in FY21 and 22?
So as I already showcased that the EBITDA margins of players, they already operate a wafer thin margin of operating margin of around 2 to 3% and net margin below 1%. And this has always been the trend. We don't foresee that there will be a drastic change in the same despite pickup in demand. Back in fiscal 18 and 19, where we saw healthy demand growth of 8% and 9%, even then the margins were limited to 2 to 3% only because of the high competitive nature of this segment. We'll see some improvement of margin from the low levels of fiscal 21, but we don't expect something extraordinary in that segment.
Okay, thanks. I've got a slightly long question now. With Europe moving from a V-shaped recovery to a W-shaped one, do we expect dumping of steel in India from China, Japan, Korea, leading to a sort of moderation of prices? And what's the differential between the landed cost of imported steel and domestic steel, like on a broad stroke?
Yeah.
So, yeah.
Yeah, so honestly, Europe had already imposed quota tariffs on India, China, Japan, Korea a couple of years back. And as part of that, anyways, you were supposed to, or you could only export, minimum of what you would have exported or an average of what you would have exported over the last 2 years or so. So, in lieu of that, with Europe now showing a W-shaped recovery in because of the trade because of the new lockdowns which have emerged in France, Germany, and so on. So there we believe that Indian companies will not really gain so much because India was largely even in EU when we were exporting, it was the proportion had already got limited, not just from India but even from China. So it is not a very key export destination except for the likes of Belgium, Italy, where we export very I think less than 20% of our overall steel. So from that perspective, we don't foresee that as a threat emerging for our exports per se or any dumping that will happen from Japan, Korea to India, because any which way we are protected by anti-dumping duty for most of the categories or almost all of the categories in the flat steel space.
Okay, thanks. I'll move on to my next question. Are steel producers actually preferring exports over domestic supply? Is that the reason why there's a shortage of steel in the market?
So domestic players, they definitely don't prefer exports because largely because of the fact that export realizations are way lower than domestic realization. So as I mentioned earlier that typically domestic player export just to fill the lacuna of domestic demand. And in fact, in the first half of the year where we have actually seen a 50-60% rise in exports, the realization gap was almost 20%. So as against a domestic price of say $500, India was exporting at say around $420 per ton. So obviously the domestic players, they will be preferring the domestic market. And as we have seen over the last couple of months, as domestic demand has risen, the players have diverted the same to domestic market and exports has been on a declining trend.
Okay. Would there be a CRISIL rating outlook for the next 2 years for MSME manufacturers?
No, we'll not be able to to that question. We will not be able to provide outlook on MSMEs per se, but in terms of our overall rating outlook for the steel industry, it continues to be stable for next year. Yeah.
Thanks, Isha. Yeah, I'll move on to my next question. Considering an impact on working capital for steel manufacturers, would HSBC outlook on it from a trade finance products both for domestic and export sale? Indiresh, would you like to take this, or Anurag?
Yeah, Anurag, you would like to take this?
Yeah. Sorry, you'll need to repeat yourself, Subhash.
Sure. So the question is, considering an impact on working capital for steel manufacturers, would HSBC's outlook be on it from a trade finance products on a domestic and export surplus be good or not?
See, we look at the SME segment per se. So steel manufacturers usually would be housed in the corporate banking side of it or the global banking segments of the bank. I would not be in a position to comment on how they would be looking at it because we majorly cater to only the trading segment, trading side of the steel business. where we will keep a case-based approach. And I had mentioned in an earlier episode as well that this is uh, this is the time which has basically segregated the people who have been more circumspect and more careful about their borrowings, and they have been able to attract more bank finance to tide through this situation. And the people who have been more leveraged, irrespective of the steel segment or not, have so the bank stand would remain that we would be able to segregate names on a case to case basis. So there is no industry wide outlook. We are not negative per se, because we do believe that this is a core industry and this is definitely going to go up once the tide turns. But we'll be circumspect and we'll also be cautious in and evaluate each case to case basis. So that's how we would look at things. And for steel manufacturers, as I said, that it is housed in a different segment, so they'll be better placed to comment on that.
Sure. Thanks, Anurag. Back to CRISIL team here now. Can we see any government restrictions on increase in steel prices in the domestic market?
So nothing that we have heard of in terms of regulating the domestic steel prices. There have been talks of the end users of steel proposing that, but we have not heard of anything of that sort, or don't foresee that to happen, at least in the near term.
Okay. Now, my next question is actually contrarian. I'm actually going to put two questions together. So, one of our viewers is saying that with auto coming back to normalcy, should it help shore demands? While the other question says that auto demand, though it's been robust, is not enough to justify this uncontrolled price and shortage. What's your take on this?
So, auto in terms of overall steel demand is 10%. And for flat steel, where we have seen major price hikes being taken, there it's roughly around 15% of the overall flat steel space. So, from that perspective, auto's demand itself is not enough to move the needle. But apart from auto, we have also seen recovery in domestic demand from other sectors, be it on the infrastructure side or urban housing sites or railway site, where flat steel gets used in the GC sheets, etc. So from that perspective, one, demand is up across most of the sector, with yes, the larger part of the demand recovery being brought in by the flats from the automotive space. But having said that, domestic steel demand recovery is not the only reason why domestic prices are up. It is also up because of the surge in global prices that we have seen. So, global prices, as Kaustav had shown in his slides, had actually they actually fell to 420, $430 back in April, May. From there, they have seen a sharp V-shaped recovery, and they went and hovered at around $520. So, global steel prices being up, coupled with currency depreciating, basically helped increase the landed price of domestic steel prices. So increase in domestic in the landed steel prices, coupled with healthy domestic demand, is what has led to this increase or the price hikes that the flat steel makers have taken.
Okay, thanks, Isha. I'm down to my last two questions. Now, presently, the whole world is sort of relooking at their relationship with China. Can India leverage on this? And also, will there be an impact on the export? Like you already mentioned this, but again, just sort of to, will there be an impact on the export of steel to China from us?
See, from
So
it, yeah,
yeah, sure.
Kaustav, go ahead.
So point is like, so in the key geographies that where India already exports the likes of Middle East, so India is already exporting to its full potential, and almost most of the large players, they're operating at a almost near to 100% capacity utilization. As I mentioned in the opportunity space, this is why the smaller players, the MSME players, can step in. That is one point. Second is, despite the fact that there's a negative opinion about China, so China, they export a lot of steel into markets, say in Africa, even in Southeast Asia, where the Chinese companies there are working on a particular project, say infra or port or roads. So it is, since it is their project itself, so they are procuring steel from China, and it is unlikely to change. As you have seen in the likes of, say, China constructing ports in Iran or Sri Lanka, and even Maldives in the recent past. all of that demand is catered to by Chinese players, and Indian players won't be able to displace them there. But because of cost competitiveness, we have seen Indian players perform a bit better vis-a-vis the previous years, and it is already reflective in the export numbers in the first half.
Okay, and with that, I'll come to my last question for today. Thank you for being so, on your feet, both of you, Isha and Kaustav. What is the market share for big players in the industry currently? So your JSW Steel, Tata Steel, sales of the world.
So on an overall level, if you consider steel industry as a whole, then that of the large players is close to 60-65%. However, they dominate the flat steel space where their share is close to 90 to 95%.
Okay, thanks. Thanks a lot. I'm very glad that we were able to answer all the questions that our customers and viewers posed to us today. Thank you, everyone. Over to you, Isha, for the closing comments.
Yeah, thank you, Subhash. So thank you everyone for attending today's webinar. To conclude, I would say interesting times await for the steel industry as we see steel prices recovery being a lot. And that too, and we are arising now at an opportune time, and we are arising now from the pandemic. Rising infrastructure investments through the government's NIP plan, rising steel applications, especially for value added steel across sectors like auto, housing, infrastructure, renewable, coupled with the domestic push for local manufacturing, pose ample opportunities for MSMEs in these space. With this, I will pass it on back to Subhash to conclude the webinar.
Thank you, Isha. So thanks again to all my speakers for today. Dilip, Adish, Kaustav, Isha, Anurag, everyone, thank you all. And thank you to all our attendees for today. Thank you for your poll votes. Thank you for your attendance. Please note that after this session, we will be sharing the entire session PPT, the entire session recording, a 6-minute audio podcast, sorry, which covers the entire session in short, as well as a one-page article that looks at the key messages that Kaustav presented today. Thank you, and we hope to see you in December for the 8th episode of the SME Knowledge series with HSBC and CRISIL. Thank you, everyone, and have a great day.